Welcome to Neon Primer Go-to-Market, where Vega and Axon break down go-to-market strategy for founders who are done guessing. New episode every week.
So, imagine running a business where almost half of your new customers actually want to buy a second product from you.
Right.
I mean, they have the money, they have the need, and they are actively sitting in your office or, on your website. But instead of selling it to them, you just forget to ask.
Yeah, it sounds crazy.
It really does. You process the first item, say thank you, and let them walk out the door. It sounds absurd. But in the world of insurance, this happens thousands of times a day.
Absolutely.
You go online to get a quote for your car, you click a button, and suddenly your phone is ringing off the hook, texts are flying in, and you're caught in this chaotic web. Yet, statistically, despite all that aggressive selling, they are probably going to forget to ask about your house.
Yeah, it is the absolute definition of a fragmented, incredibly fast-paced market. I mean, the consumer experience is pure chaos, but there is actually a very deliberate, albeit sometimes flawed, architecture behind why that happens.
And that architecture is exactly what we are getting into today. Welcome to this deep dive. Our mission today is to decode a comprehensive strategy document titled Most Effective Go-to-Market Strategy for Insurance Agents and Brokers in the United States.
The hefty one.
Oh, totally. This isn't just dry theory. We are going under the hood of an industry that you and literally everyone else interacts with, but, well, very few truly understand. We've got a stack of hard data from J.D. Power, Deloitte, Marshberry, and some incredible real-world case studies to uncover exactly how the insurance industry is surviving and thriving in a volatile market.
Which is so relevant right now.
Exactly. So whether you're a sales professional, an entrepreneur, or just someone curious about why your auto insurance shopping experience feels the way it does, there are going to be some surprising aha moments today.
Okay, let's unpack this. I mean, where do we even begin with a market this complex?
Well, we have to start with the fundamental philosophy driving the most successful agencies right now. The core reality of the market is this. Purely digital strategies are just completely dead.
Oh, wow. Dead. Yep. And purely human old-school strategies are equally dead. The winning formula, at least according to the research, is what the industry calls a segment-first, human-plus digital multi-channel model.
Wait, I want to pause on that. Purely digital strategies are dead. I mean, we've seen tech disruptors completely remove the human element from banking, from booking travel, buying cars. So why hasn't a pure software platform completely replaced the local insurance agent?
Well, what's fascinating here is that the data completely backs up the survival of the traditional agent, despite all those tech disruptions you just mentioned. Independent insurance agencies still absolutely dominate the market.
Really?
Oh, yeah. They are currently placing about 61.5% of all U.S. property and casualty premium.
That's massive. And property and casualty, that's just the P&C stuff, right?
Right, exactly. The insurance that covers your physical stuff and protects you from liability if you, say, accidentally injure someone else. And get this, in the commercial business sector, independent agents hold a staggering 87.2% of the premium.
Wow.
And they even hold 39% of the personal lines market. The reason a pure app hasn't wiped them out comes down to the nature of the product itself. I mean, booking a flight is just a transaction, but buying insurance is a legally binding financial protection against a disaster.
Right. So it's not like humans versus the machines. It's humans teaming up with the machines.
Mm-hmm.
It makes me think of almost a cyborg approach.
A cyborg approach, I like that.
Yeah, like you're using technology to give the human agents robotic armor, making them faster and more effective, rather than trying to build a fully autonomous robot that just replaces the human entirely.
That is the perfect way to look at it. The direct-to-consumer digital channels, your pure robots, so to speak, only work when the economics and the target customer segments are perfectly aligned. They are not a standalone substitute for human advice. I mean, State Farm literally calls their winning pattern a human plus digital approach.
That makes a lot of sense.
Yeah, and the necessity of this blended model really crystallized during the severely hard market of early 2024.
Oh, man. I remember that period. My own auto insurance rates spiked, and it felt like everyone was talking about how expensive coverage had become.
Yeah, that's exactly what a hard market is. You had, rising interest rates, immense catastrophe losses from severe weather events, and skyrocketing costs to repair vehicles and homes.
So everyone was feeling the pinch.
Exactly. And when a customer's premium suddenly jumps by 30%, or their policy is dropped because they live in a wildfire zone, a chatbot just cannot synthesize empathy. It can't offer complex risk advice. Customers absolutely want the speed of a digital quote, but when the financial stakes are that high, they desperately need a human being to explain the coverage and retain their trust through that volatility.
Okay, so the cyborg philosophy makes logical sense. You use the digital side to handle the speed of the data, but you keep the human in the loop to handle the complexity, the nuance, and the emotion of the buyer. So, knowing that this is the baseline, how does an agency actually put that into practice? Because selling a basic auto policy to a college student has to be a mechanically different process than selling a complex liability policy to a commercial roofing company.
Oh, absolutely. The strategies completely diverge depending on what type of insurance is being sold. Let's look at personal lines first. So, your everyday home and auto policies. For personal lines, the game is entirely about speed and price. Auto insurance acts as the front door.
Like it's the shiny object that gets them into the ecosystem.
Exactly. The J.D. Power 2026 shopping study notes that auto shoppers are highly active right now. They're gathering an average of 3.5 quotes when they shop. But this brings us back to the scenario we opened the deep dive with.
Right, the forgotten house quote.
Yeah. Here's a crucial statistic from that study. 45% of recent auto shoppers also own a home and have homeowners insurance. Yet only 20% of them received a homeowner's quote while they were actively shopping for their auto policy.
Wait, so agencies are just leaving massive amounts of money on the table by not quoting the house with the car? Is it really just an issue of speed?
It is entirely a symptom of speed. Or, well, rather a workflow failure masquerading as an issue of speed. J.D. Power's 2026 data emphasizes that quoting speed is no longer just a back-office processing metric. It is a front-office, go-to-market necessity.
So they just don't have the time to ask about the house.
Right. Agencies know that price gets the customer in the door, so they rush to get that competitive auto quote out before the customer clicks away to Geico or Progressive. And in that rush, the agent skips the secondary screens.
Just to save a few minutes.
Exactly. I mean, retyping a customer's address, roof age, heating system into a separate legacy software system takes time. So to win the auto race, they completely drop the ball on the bundle. The research clearly states that personal lines agencies need to integrate their technology to organize around households, not individual policies.
Got it. So the tech needs to be smart enough to pull the home data automatically while the agent is securing the auto quote. Okay, so that covers personal lines. What about the commercial side? The businesses.
Well, commercial lines require a very distinct two-part motion. You cannot treat all businesses the same. Simple small business risks like, say, a local coffee shop or a freelance graphic designer, they just need basic coverage.
Keep it simple.
Right. They usually buy a business owner's policy, which bundles basic liability and property, maybe some standard workers' comp, and basic cyber protection. That process should look a lot like personal lines. It should be run through a fast, digitally assisted quoting motion.
So fast, cheap, heavily automated.
Yes. But if you're dealing with complex middle-market businesses, say a manufacturing plant with a fleet of delivery trucks and overseas supply chains, that cannot be automated away.
Too many moving parts.
Exactly. That must go through a verticalized, specialized advisory broker. It requires a consultative human approach where the agent acts almost like an outsourced risk manager.
Here's where it gets really interesting. Because the actual product you're selling completely dictates the speed, the technology, and the sales approach you have to take. But who is actually executing this? I mean, a small family-run insurance shop on Main Street cannot possibly play the exact same game as a national broker with 10,000 employees. So what stands out to you about how these different players are supposed to compete?
What really stands out is that survival in this market requires extreme operational self-awareness. You have to know your size and your structure. The source material outlines custom playbooks based on the exact type of agency you are.
Okay, break that down for us.
Let's start with the small captive agencies. And captive just means they represent one specific carrier brand. So think of the local agent with the big, recognizable corporate logo on their storefront.
Right, they're sort of like franchisees. They can only sell what the mothership provides.
Exactly. Because they are captive, they can't shop around for the lowest possible price across 50 different companies. So the playbook says they should absolutely not try to imitate independent comparison shopping. If they try to compete purely on price, they will lose.
So what's their play?
Instead, they need to lean hard into their recognized brand name, target households in a very tight geographic radius, and heavily cross-sell adjacent products like life insurance or umbrella policies to the people already in their ecosystem.
Oh, that makes total sense. They use the corporate brand as a shield to build local trust and then maximize the lifetime value of every family they insure. What about the small independent agencies, though? The ones who aren't tied to one brand and can sell from a dozen different carriers.
They have to play a completely different game. They don't have the billion-dollar advertising budget of a captive brand. So small independents must build one or two highly defensible niches. And the data from Easy Links is incredibly revealing here. 89% of these agencies cite referrals as their key source of new customers.
Wait, 89%? That implies digital marketing, like buying Google ads or social media campaigns, is almost entirely ineffective for them. Why is that?
Because the cost per click to bid against the national giants is just too expensive. If a small independent tries to just be a generalist selling auto insurance on the internet, they bleed cash.
Oh yeah, they get crushed.
Exactly. But if they decide to become the absolute foremost expert in insuring, say, dental offices or local craft breweries, their reputation spreads within that specific community. Every dentist refers them to the next dentist. Referrals cost nothing to acquire, which protects their profit margins.
So specialization is literally survival for the small independent. And how does that scale up? Like what happens when we look at the mid-size commercial independents?
For the commercial independents, their mandate is to ruthlessly separate their workflows. They have to split the simple small businesses we talked about earlier from the complex middle market advisory business. And furthermore, they need to organize their producers, their sales reps, by specific industry verticals.
Let me make sure I understand the mechanics of that. You're saying an agency shouldn't just have 10 general salespeople taking whatever calls come in. They need the construction expert sitting at one desk and the restaurant expert at another.
Precisely. In the middle market, clients expect their agent to understand the specific safety regulations, labor laws, and supply chain risks of their specific industry. A generalist simply cannot speak the language of a commercial contractor well enough to win a complex account.
Okay, so we've covered the small captives, the small independents, and the mid-sized commercial firms. What about the giants, the large brokers like Hub International?
Well, large brokers have a totally different mandate. Because they usually grow by acquiring hundreds of smaller agencies, their biggest threat is internal chaos. They must invest heavily in centralized revenue operations and standardized workflows.
To wrangle all those different pieces?
Exactly. In fact, one of the case studies in our sources notes that Hub had to unify close to 9,000 users onto a single platform just to eliminate the inefficiency of disparate systems.
The irony there is brilliant. The massive, complex, global agencies actually need the simplest, most standardized systems to survive the weight of their own scale, while the small, local, independent agencies need to build complex, highly specialized referral niches just to stay alive. It's like the exact opposite of what a consumer might expect.
It's a great observation, and it transitions perfectly into the actual engine that powers these agencies.
Okay.
Because you can have the perfect playbook for your size, you can know exactly what your strategy should be. But if your internal engine, meaning your tech stack and your talent model, is broken, the entire strategy collapses.
Right. Having the perfect recipe doesn't matter if your kitchen appliances are from the 1980s and keep short-circuiting. Let's dig into that tech stack first. What does a functional engine actually look like, according to the research?
The foundational rule laid out in the strategy is centralization. Agencies need one single system of record, one pipeline system for sales, and one marketing engine. Crucially, they all have to talk to each other seamlessly. But the reality on the ground is that most agencies are operating a patchwork of disconnected software, especially when it comes to the industry's newest obsession, artificial intelligence.
Oh, of course. AI. Every industry right now thinks AI is a magic wand that just fixes everything.
Yeah, and this raises an important question. What happens when an industry tries to adopt advanced AI before it has even digitized its basic workflows? According to a 2026 report from the Agents Council for Technology, 68% of agencies plan to increase their use of AI in the next 12 months.
Sounds about right.
But here's the alarming part. Only 8.29% use it regularly and strategically today. Even worse, 56% of agencies have absolutely no written AI policy.
Oh, I see the danger there. If 56% of agencies have no written policy, you have rogue employees plugging sensitive client data like social security numbers or health records into open source language models just to draft an email faster.
Exactly.
That is a massive data privacy violation waiting to happen. They are jumping straight to the finish line before even paving the track.
That's spot on. The report explicitly warns that technology must simplify workflows before it adds AI. If you apply AI to a broken, decentralized process, You don't get innovation. You just get a faster broken process.
Yeah, that makes a lot of sense. So the tech side of the engine requires extreme discipline. What about the human side? How are these agencies structuring their talent to actually execute this cyborg strategy?
This is where Marshberry's 2025 compensation data provides a real reality check. They analyzed the structure of modern agencies and found that service personnel, so the account managers, the customer service reps, the people answering the phones, make up 58% of the total personnel in an average firm.
Wait, let's break that down. Nearly 60% of the staff doesn't actively sell anything new. Isn't having over half your team just playing defense a terrible way to grow a business?
It sounds counterintuitive, sure, but in an industry based on recurring revenue, retention is growth. You need that defensive line. However, the winning strategy, the way the highest performing firms handle this, is by drawing a hard line between selling and servicing.
Okay, how so?
The data shows you must pay your producers exclusively to hunt for new business, and you pay your service teams to retain the existing accounts. Marchberry found that average firms often pay their producers too much commission for just redoing old policies.
Oh, which completely kills their motivation to go out and find new clients. I mean,
Yeah.
if I can make a great living just babysitting the clients I sold 5 years ago, why would I ever cold call a new prospect?
Exactly. That's why high-performing firms restructure the compensation. They push the commission spread between new and renewal business to a 15 to 20 percentage point difference.
Oh, wow.
Yeah. For example, they might pay a producer a 40% commission on a brand new sale, but only a 20% commission on a renewal. That financial disparity mathematically forces the hunters back out into the field to grow the business.
I see the logic there. It's almost like managing a professional sports team. You don't want your star striker in soccer dropping back to play goalie just because they're comfortable there. You want the hunters up front scoring goals. And you let the dedicated goalies, the service team, protect the net and keep the clients happy.
That is exactly the operational dynamic you have to achieve. You cannot ask one person to excel at aggressive sales and meticulous customer service simultaneously.
All right, let's take a breath and look at where we are. We've got the cyborg philosophy. We understand the divergent paths for personal and commercial lines. We know the custom playbooks by agency size. And we've tuned up the tech and talent engine.
We've covered a lot of ground.
We have. But moving fast with specialized workflows and aggressive sales hunters sounds amazing in a vacuum. What happens when this pristine strategy hits the brick wall of the real world? Specifically, government regulations and the actual financial cost of building this engine.
Well, that's where the guardrails come in. They're entirely unforgiving. Let's start with the financial reality. The strategy document models out what it actually costs to build this go-to-market engine. If you were a small captive agency, the modeled first-year incremental spend is roughly $150,000 to $350,000.
Okay.
But if you're a large broker or a multi-office consolidator, you are looking at an initial budget of $3 million or more.
$3 million is a substantial investment just to upgrade how you sell. Where exactly is all that capital going?
The recommended budget allocation is very disciplined. It should follow roughly a 30 to 40% allocation to the foundation. That means funding data migration, unifying all those disparate legacy systems we talked about into one CRM, and establishing legal compliance.
Okay, got it.
Then another 30 to 40% goes to demand generation, things like SEO, paid search, and partner programs. And the final 20 to 30% goes toward retention, like automating renewal workflows.
So they deliberately force agencies to spend on the foundation first. Because, I mean, if you dump your budget into demand gen to buy thousands of digital leads, but your CRM is broken, those leads just fall through the cracks. And earlier we talked about text messages flying in the second you click for a quote. I have to imagine automated text messaging systems represent a legal minefield.
Oh, they absolutely do. And the compliance guardrails are stricter than they have ever been. Recent updates to the Telephone Consumer Protection Act, the TCPA, have completely changed the rules regarding automated text messages and calls. The law now requires prior express written consent that is tied to one seller at a time.
Wait, what does one seller at a time actually mean in practice? Because it used to be that you'd put your info into a comparison website and suddenly 50 different agents were legally allowed to call you.
That entire spray and pray lead generation model is completely dead. Under the new rules, the consumer has to explicitly check a box consenting to be contacted by one specific named agency.
Oh, wow.
Yeah, and because of this, agencies must now capture and securely store exact time-stamped evidence of that digital consent within their CRM systems. If they don't have that foundation built, They invite crippling class action lawsuits.
Okay, so building the cyborg engine is expensive, it requires intense discipline, and it is highly regulated. Do we actually have proof that this level of complex transformation pays off for the agencies that get it right?
We do, actually. The source material is packed with real-world case studies showing profound efficiency gains. Take Rollo Insurance Group, for example. By implementing specialized workflows and centralizing their tech stack, they cut the time it takes to quote a complex, multi-line small commercial account from 2 to 3 hours down to about 1 hour.
That's huge.
And in that single hour, they're delivering 3 to 6 different quotes to the client.
That is an incredible metric. They reduce the workload by 2/3 while simultaneously increasing the value they deliver to the buyer.
Exactly. Another example is an agency called Rideshare. Using a technology platform called Zywave, they launched a multi-state digital quoting system in just 30 days. Within 1 year from that single centralized digital site, they wrote 24,000 policies and processed over $100 million in premium, all without needing to open physical brick-and-mortar offices in every state.
That is the literal definition of achieving scale through technology.
And if we want to look at the absolute extreme end of automation, there is a case study regarding lead qualification handled by a vendor called EHVA for all state offices. They set up an automated system that successfully handled 35,000 calls a day across 1,200 offices.
35,000 a day.
Yes. This automated system asked 19 specific intake questions and pinged 4 live APIs per call.
Wait, let me stop you there. What do you mean by pinging live APIs during a phone call?
Well, an API is essentially software talking to other software in real time. So while the automated system is talking to the customer, it is simultaneously pulling data from a database to check their driving record, pinging another to verify their home square footage, and pulling public property records. It does all of this data gathering before a human agent ever picks up the phone.
So what does this all mean? I have to push back on this vision of the future. With 35,000 automated calls a day and software quietly pulling your driving record while a robot asks you 19 questions, aren't we risking losing that human trust we established as the core philosophy at the very beginning? Doesn't the cyborg just become a cold, calculating Terminator?
It sounds like it would, but if we look closely at how humans actually behave, it's quite the opposite. The technology is designed to absorb the friction of the transaction. Think about your own experiences. Asking someone to spell their street address 3 times or demanding they dig through their files to find their exact vehicle identification number, that doesn't build trust. It builds annoyance.
Yeah, that's true.
By using automation and APIs to handle the baseline data collection, you are fiercely protecting the human agent's time. The machine handles the interrogation precisely so the human has the energy, the patience, and the time to handle the actual conversation.
Ah, I see. You outsource the data gathering to the robot so the human agent actually has the bandwidth to sit down and say, hey, I see you have a teenage driver in the house. Let's talk about how to protect your assets if they get into an accident. That makes a lot of sense.
Exactly.
Well, there you have it. If you are running a business or managing a sales team, this deep dive is an absolute masterclass in market segmentation, workflow discipline, and understanding how compensation drives behavior. And if you are just a consumer, well, now you know the exact mechanics behind the curtain.
It really pulls back the veil.
It does. You know why you get those hyper-specific texts from agents, why your auto quote came back so blindingly fast, and why, statistically speaking, they really should have asked you about bundling your home insurance while they had you on the line.
The machinery behind the scenes is incredibly complex, requiring constant maintenance and strict legal compliance. But when an agency aligns its technology and its talent perfectly, it feels completely seamless to you, the buyer.
It does. But it also leaves us with one final lingering question to ponder based on everything we've uncovered today. We've talked extensively about this cyborg model, where the tech handles the speed of the data and the human handles the nuance of the advice. But what happens when technology and AI eventually become flawlessly accurate at predicting risk and generating perfect, customized quotes instantly without needing any human translation? Will the human advice portion of insurance shift entirely away from explaining coverage? Could the local insurance agent eventually evolve into something resembling a financial therapist, someone there simply to hold your hand and provide emotional reassurance in a fully automated world? Something to think about the next time you click Get a Quote and that invisible complex machine sparks to life.
If you got value from this, share it with someone building something real. And if you want to stay sharp on go-to-market, follow Neon Primer GTM. We'll be back with more.